So should this happen, should the interest rate cap be repealed, if you remember when it was first put in place, there were both intended and unintended effects. Intended not so much, the unintended have really become, that's why we are here today, because of the unintended effects. Should the interest rate cap now be removed, what do you foresee as possible intended and unintended effect? What would happen? Let's look forward and say, let's say it was repealed this week, for example. In how many months would we start seeing X, Y, Z happening? What would you forecast?
I think that's a good question because of the fact that when the law is repealed, I think the other thing that we need to go hand in hand with it,
not if, is
what safeguards do you put in place to ensure that we do not slide back into those challenges that we are trying to address in the first place.
Okay.
So, and a number of things have been proposed and have been put on the table. One, even by the cabinet secretary himself. The cabinet secretary himself has come up with a way of trying to ensure that there is some, some regulation on the financial markets conduct. And he has come up with a raft of proposals. One is to put in an authority in place. One is to have an ombudsman. Then the other one is to have a tribunal, to just manage the financial markets conduct. There are issues there in terms of how they are going to operate side by side with the other regulators, central bank being the main one, but that's an issue that can be tackled. But the issue that is trying to bring up is the fact that we need to address the issue of consumer protection. So that is the proposal by the CS to the National Treasury, which is now under consideration, or CS to the essentially he wants to bring it forth to Parliament.
Yes, that's right.
But as an industry, what have we done to ensure that we have put in safeguards to ensure that when the law is repealed, we do not have an industry that is sliding and being perceived by the consumer as an industry that is not responsive to their needs. And also, by the way, part of what we are blamed for as an industry is not something that is purely for the banking sector, but the whole private sector, the whole credit market, which some of the high rates that were being touted around were actually coming from the informal sector, but generally you view it as the banking sector, But anyway, we have now tried to put in place...
That's debatable, but carry on.
We have now tried to put in place mechanisms to ensure that we address those issues. And one of them, for example, is last year, we came up with a code of ethics for the banking sector. This code of ethics is closely aligned to what the private sector has in terms of code of ethics for business.
And every bank signed on to this
code of ethics. Banks signed on to it, but also now, after that, we also came up with a code of ethics for the banking sector, which we went through the process. We had it adopted by the governing, by the member body towards the end of last year. Now we are in the process of rolling it out. This one is purely to ensure that there is a level of discipline in the banking sector, and we also have a tool through which we can ensure that our members are aligned to that code of ethics.
Okay.
That's one. The other one is, for example, transparency in the banking sector was a major issue because of the fact that banks were not able to compete on price. So a consumer gets a price quotation from one bank and he doesn't know what is being quoted elsewhere. There is so much opacity in how the rate is arrived at. What you have tried to do is to come up with a framework where there's transparency. The consumer himself can be able to compute the rate from one bank and then see what the other bank is offering for the same product and, so to speak, vote with his feet. So he can move from one bank to the next that he sees is giving a more competitive price.
And they had that option. Okay.
And that is now being facilitated through KBA and Central Bank on this platform where a consumer can log in using his mobile and be able to check across the banking sector.
Okay. And
that's
sort of compare and contrast.
Then the other one which he mentioned about is the fact that banks have not been able to price price risk appropriately. And there is this CIS mechanism, the Credit Information Sharing Mechanism, the so-called CRB, which really was meant to do that so that you can be able to differentiate between good borrowers and bad borrowers and price it accordingly. The mechanism has not worked as well as it should have worked, but at least there's some progress happening. We now have the CRBs giving credit reports, and on that basis, if banks can start now using those credit reports for purpose of pricing the loan, so that good borrowers, and by the way, most borrowers are good. The bad borrowers are a very small proportion. Right now it's about 10%, for example. So we have got 90% who are very good borrowers like you and me.
Yes, all of us on this
and those are the ones who should benefit from this framework, where if I've got a good track record, I should be able to use that track record to be, for the bank to give me a better rate, either a better rate or better terms in terms of the borrowing. Okay. So with that framework in place and banks using it, then we'll see borrowers being differentiated, and therefore the good ones being given a benefit. And so you see the prices coming down because 90% of the market is not up there in terms of risk. They are down. And so if they are appropriately priced, the rates start coming down. So it's a raft of measures that I think can be put in place to ensure that we secure the market, to ensure that the previous grievances that were coming out of the market are addressed. Okay,
fair enough. Even as you give me your final thoughts, Maurice and Joram, let me read 2 SMSs that are on the same note. Lillian from Meru is asking, should the banks interfere with the already borrowed loans should the interest rate cap be repealed? I think the already borrowed loans should remain intact. That's Lillian from Meru. And someone called John, but you don't tell us where you're writing in from. You say, I'm currently servicing a loan. I took the loan based on the current 14% rate. My fear is that my net salary will not be enough to accommodate the new loan premium, which will obviously be revised upwards once the cap is removed. How will the cap's removal protect such people currently servicing loans? So I'll give both of you, and I'll also give you a chance. I'll come back to you and see if you can respond to that. So you can talk about this even as you tell us what you also wanted to tell us.
I think if you look at what we've seen so far in terms of the effect of capping of interest rate on loans, it has negative effects. First of all, we've seen banks changing their mode of operation. Most banks are laying off staffs. Banks are closing branches, so that at least they remain cost efficient in terms of how they are running the operations. And initially, the intention was not so that banks could do this. Remember, when we are discussing a sector, we have to be very cautious because banks are one of the key employing sectors in Kenya. And again, banks are one of the key sectors in terms of remittance of taxes to the KRA for the funding of government operations. So we need to be very cautious when we do this, because we might end up killing a specific sector. But at the end of the day, the main thing that is still coming up, that we are dealing with access to credit. We are not dealing with how banks are advancing loans. That's where we are missing it. We should ensure that when we are dealing with access to credit, we deal with this holistically. And at the end of the day, what we need to ensure, because I keep on saying, if you look at the developed markets, banks provide only about 40% of the funding in the economy. If you look at in Kenya, they do almost more than 90%. That's why
that's our problem.
That's the main challenge. And now how we are addressing that challenge is also not a solution enough, because
so who should address it? Is it private individuals? Is it government? Is it foreign investors?
It is private individuals, and also private individuals need to be sanctified through a legislation framework that encourages them to do these things. Because for now, they don't have the push, the motivation to do it, because no law gives them the advantages and the leeway that other institutions are getting. A good example that I gave now, how will this private individual raise money? If you give me money so that I work on how to loan it out, your tax is advanced. You will pay another 15%, take it to 30%. You will say, let me take my money to the bank, 15% will be final.
And keep it there, and rather than loaning it out.
Exactly. And if you look at where we've come from with this controlling of the interest rate on borrowing, remember the don't the law, don't the bill. We've come from very far. But at the end of the day, we need to look at even case studies. There's no success story in the world where capping of interest rate has worked. Zambia, they did it, they repealed it after 3 months. West Africa Monetary Union, they did it, they repealed it. So at the end of the day, we also need to look at other areas that have tried to do this thing and see whether they have had success.
Fair enough. Okay, thank you. Joram?
I guess there's a saying that you should never waste a good crisis.
That is true. That is true.
I think we're probably in a space where now we can have a proper conversation around how to deal with the problem holistically, not just the repealing, but also what are the surrounding factors. As he says, there's a lot of alternative capital. Where are the billionaires putting their money? Why aren't they supporting startups and growing businesses in this country? Where are your venture capital, private equity firms, where we have chamas and, circles and investment companies that they have a lot of money, but everyone is just pouring money into property, and we're increasingly having an oversupply in certain areas. So there's a lot of capital that is floating around, but I think there's a lot of need for education. I think there's a law that was passed that now finally allowed pension funds and insurance companies to start putting some money towards private equity investment and that kind of thing. So there's a much bigger picture, but I think what's missing at the end of the day is the education of these business people and the SMEs of the alternatives and the different ways. I mean, you find foreigners coming here and they start accessing $3 million worth of investment, as a startup. Why isn't that happening with the locals?
How are they doing
it? Yeah, how are they doing it? They actually invest a lot of time in learning how to raise alternative sources of capital. We had a Kenyan company, Cellulant, the other day that was able to raise 4.8 billion. So I think there's a lot of alternatives, but maybe as Kenyans, we always tend to be very myopic and look at very few alternatives of how we can do things. So maybe one of the things is that we need to open up this conversation and start looking at what are the alternatives out there, and how do we educate people around those alternatives so that we open up the space to grow the pie of the economy.
Fair enough. Habil, you have the last word on this. Please help us. Give me your thoughts. Your thoughts might not be what will happen, but they are asking what happens to those who are servicing loans should what you're hoping will happen actually happen.
Yeah, I think that's a good point, but I just wanted to add something to what you said.
That's okay.
I think the issue about alternative sources of funding also goes hand in hand with the consumer education. You see, a number of SMEs actually think that when you need funding, the right type of funding is debt, which means a bank loan. Sometimes it's not. Sometimes you actually need what we call patient capital to be able to build up. Because you see, a loan, when you get a loan today, the repayments kicks in almost the next month. And it's a given amount, irrespective. So if you're at a stage whereby you're still building up the business, and therefore you need some patient form of capital, most probably you'll require a loan, a friendly loan, from either family or some other source, or what you call private equity or venture capital. You mentioned, the so-called patient capital, which then comes in and stays longer to enable you build up so that you can start repaying or giving the return much, much later. But a loan doesn't have that kind of a structure.
No, it doesn't.
Come in today, tomorrow, whether you've got the cash flows or not, you're supposed to start repaying, and that's why you now fall into debt. So sometimes I think we push these entities into the wrong form of capital, relying on the banks when banks may not be the solution. But I think coming back to your question about
these two
lady who asked that question, and I think it's a very relevant question because of the fact that the main worry today is for the borrowers who are already in the banking sector, and their worry is that when the capping is removed, their loans will fly back to.
In fact, can I add something to that? I know people who have actually put their borrowing on hold. They are waiting to see what will happen.
What will happen, yes. Now, I think one of the biggest concerns currently has been the fact that there are a number of borrowers out there who are not able to access funding, partly because we are not able to price them within what the law has provided. So when the cap is removed, you'll then be able to appropriately price them and offer them something to come in. I mean, he was talking about the fact that people are being forced to borrow at 20–30% per month. That person will be able to be priced at something not necessarily 14, but possibly 15, 16, 17, which will be a much more affordable alternative than not having access at all.
But to what? To the detriment of existing borrowers?
The existing borrowers, I think that's now an issue that I need to address separately, because I was talking about those who are out, who need to
now come into the...
Now, the ones who are in, it effectively means that if they are in, they have most probably been priced appropriately. So they are living within their price, the risk profile that has been priced appropriately. Now, some of them may actually have been forced to come down partly because of the law in order to fit them in, which means that when the law is removed, and the industry is actually responsible, they are not going to start, hiking, people's rates to, unknown levels.
Can we hold you to that?
If at all there is an adjustment, it most probably would be something very small. But I think the biggest benefit is the fact that now you are able to price those who have been locked out, and now they are able to come in after being appropriately priced. But you're not going to start repricing the existing portfolio.
Okay, where people get emails saying from next month, this will be your new repayment, and it's 4% or 5% on top of what?
That is unlikely to happen. I think as an industry, we are also responsible to our borrowers.
Okay.
In the sense that these are our customers, not somebody out there. These are already an existing customer whom you have already built a relationship with. Why should you destroy that relationship? By the fact that the law has been amended and therefore you now become irresponsible and go all over the place. And also the other thing is this, that if we become irresponsible, we still have the same parliamentarians, we still have the same angry crowd coming for us, and the law can easily be, be put in place. So we also have to act responsibly. In other words, there will be consumer protection measures that will be put in place to ensure that the consumers are also protected.
Okay, thank you so much for that. And that's how we wrap up this discussion. Thank you so much, Maurice, Habil, and Joram, for finding time to be here with us. I hope you who's watching has learned something. And for those who asked that last question, We certainly hope what her bill told us is what will exactly happen. You know, when you're a journalist, you remain skeptic all the time, no matter how genuine the person talking to you is. Time will tell how this happens. First of all, whether the repeal happens, because it sounds like Parliament will have the final word. But then once it happens, should it happen, how banks will then respond to the ability then to, in a sense, vary at what rate they lend out at. Thank you for that. Thank you to everyone who took time to SMS in. We take a short break. You're watching Citizen Extra. Stay with us. The program continues shortly.